The key is right now it's good is bad and maybe bad is good, but maybe not too bad. We got the issue. Are we going into recession? Are we about to see a pickup of inflation? We'll cover some of this stuff and its impact, and then we'll get to our top three today. But Blake, the monthly jobs numbers, market not liking it so much.
Yeah, isn't that kind of weird? We report good and we get clobbered. We have better than expected and it falls down. Why would you think that the market would be punitive to a better than expected jobs data report? What's our real focus? Apparently it isn't jobs.
Yeah, right. So we added 256,000 jobs. But clearly, the market is all about pricing and rate cuts.
Yep.
Higher jobs, lower unemployment, higher wages, inflationary. The Fed's less likely to cut. Thus, the market is experiencing weakness today. And you look at the expectation again, 164. We got with 256. Last month was about in line. Huge miss in November. So again, this was a positive for the market because we missed. The Fed's going to cut, right? We're pricing in rate cuts. Now, all of a sudden, what's happening?
Great job. So no rate cuts. In fact, the data's swung back and forth a little bit with the volatility, but the ZQ is pushing back about 3 months as far as our expected percentage. And now it's even looking like October before we have a guaranteed rate cut. And so you'd have to look at the
I know.
CME or the ZQ on
Yeah,
the trade tab so you can price in the future Octobers there so you can see the
that's right.
numbers, just so you
Super
can see all of them
prevalent.
all
So
at
in 21
once.
days, so you can see here we're basically a very, very small rise going out to May, right? So we're
Yeah.
kind of pulling back here.
Yeah, so and just that difference, you can do the fast math on this from now 95.67 to 95.78. That little point oh 0.09 move, point oh 0.09 is what that equates to is a 3.6% higher likelihood of a rate cut by May than current. That's not very much. And so
Yeah.
it did really diminished it. It pushed it all the way out, like I said, at least October. And so we thought we were going to get 4, and then we said 8 by
Hmm.
December. And now
I would
we're
say
back
two.
down. Yeah.
Yeah.
Now we're saying October is really where we see that full cuts being priced in.
Yeah. I mean, this is again, the market right now is we're kind of in a position where we're really, again, we're it's all based on what? Fed liquidity. And if we take a quick look at where we're currently stand in terms of stocks above their 50-day moving average, we're in a pretty low territory. 25% of S&P 500 stocks are above their 50-day moving average. And you can kind of see back at past points, 2020 was a lot lower, 2019 here. We're kind of in a territory down here around 25% where markets typically bottom. But here's the other side of the story, right? Are we going to see a continued downward slide in the market? So we look at the 200-day moving average, and what you're seeing is we still have a lot of stocks above their 200-day moving average, 53%. We look back here 2022, 2020, 2018, it was around 20%. So is this the end of the pullback and we just fall below the 50 and we rally off this? Or does the monthly jobs report and other factors in terms of inflation ultimately drag these stocks to get back down here below the 20% stocks above their 200-day moving average? Because right now it's about 50-50. And this is the uncertainty, but the reaction today may suggest maybe we do have additional downside in the market right now as a result of inflation expectations picking up, which we'll talk about here.
Yeah, and the BLS, if we dig a little deeper into those numbers, we can talk about the idea that the Fed is going to cut rates or not cut rates or delay the cut rate and all the things that we want to look at to tell us whether or not they're going to save the day. But when we look at the actual employment data, not just whether they added more jobs or not, but what is going on inside, including looking at yesterday's jolts and today's numbers, is it as a rosy picture as we might hope as far as the long-term economy is concerned? And there's some data in here that's showing there's a lot of weakness in that increasing number.
Yeah.
So I thought it was interesting anyway.
Yeah. I mean,
Go ahead.
the goods produced, I mean, we have this pretty big divergence here between manufacturing and service. Service has held up pretty well. Manufacturing or goods producing parts of the economy Not so much so. So goods producing shed 8 million jobs last month. The service producing was 231 million. Obviously, we're kind of talking about retail trade, 43 million. So again, we're kind of adding in those areas, temporary help services, 5.3. We got private education health services. So we're adding in the service. We're just not. A lot of people are pointing to construction seeing a downturn, but we're still added 8 million jobs there in the construction. But anyway, goods producing, the manufacturing part of this economy is struggling right now. It's kind of the service part, it's spending, it's debt. Blake, you had an interesting note about expenditures. What was that?
Yeah, so I was pulling up the expenditures that was part of the survey and the PCE, and expenditures. If you look at let me find my actual number, my exact number. Um, Expenditures year over year in the U.S. was $77,000. So we spend about per household $77,000. If we're spending $77,000, just right off the top, I hope everybody in the back of their mind said, wait a minute. If the average household spending is $77,000 in expenditures, is there a number that's a problem already? And that is the average hourly income is 59,384. So we'll call it 60,000 or 59,000, somewhere in there. Do you see a problem here?
We have a gap, right?
We
I
have a
mean, and
major
that's what
gap.
we look at, credit card debt, revolving debt. I mean, this is just exploding, but delinquencies are exploding as well. I mean, a lot of stuff's happening right now. We're seeing job openings have been on the decline. We saw a little bit of a tick up in the last month to 8,098. These are millions, but anyway. Um, yeah, kind of, or thousands rather. 8 million jobs openings.
Yeah.
But
And
yeah, it's a big gap. Job openings are coming down, ticked higher. Um, look, I mean, it's a problematic position that we find ourselves in right now, with jobs being hot and the market itself is lagging. Yield curve's coming inverted. U.S. quits. Blake, what's your color on quits?
well, that's the other aspect that is really interesting. So they track in JOLTS, they track all the people, all separations. They call them separations. So you have everybody that quit, everybody that got fired, everything that was a layoff or temporary layoff, all that stuff when they look at separations. And what they saw is that quits dropped at one of the fastest rates they have ever. And so when we see the quits drop, it means that people are not voluntarily leaving. That's usually the bigger sign that they are avoiding leaving because they don't think they can get another job.
Yeah.
They don't think they can walk from one place to the next and step in the other door. And when you're looking at that quits data as well, the quits data, when you adjust for the total number of separations, it means that there were a lot more layoffs because they said, oh, it barely changed that we saw any separations. Well, we had a huge number of people not quit compared
Yeah.
to previous timeframes. So what that's telling us is the quits decreased by 3 million, meaning 3 million lower quits, but our total separations were the same. That means we had 3 million more layoffs.
Yeah.
You've got to put all the pieces together here. And so companies are firing people. Our net result is they're firing people. They may be opening more jobs, but we also see 3 million people less voluntary leaving, looking for another job. That's also a sign that the people are concerned and they're trying to be stable at this point in their job.
And CRM, just announced that they're not hiring anybody in 2025, right? I'm like,
Yeah.
so we may be on the cusp. They feel AI gains and other factors. They just don't need more people. So the whole learn to code, phrase was used I mean, now all of a sudden coding is expendable, like unlike
Yep.
Rambo. Rambo's not expendable.
Yeah.
But if you're a coder, I mean, you're expendable, right? I'm like, so again, we're seeing advances in technology leading to lesser job opportunities, and Salesforce certainly showed that today. And it didn't really based on the business decline. It was just AI gains and being able to meet the needs of their business. Um, so let's kind of put this together. So, we have a scenario of the bond and the coal mine. Bonds are creating a problematic environment for stocks. It's not just an alternative, it's also reflective of inflation. But yields today are really popping. We're at 4.7% on the 10-year. We uninverted the yield curve here. So now all of a sudden we have a positive structure. So TNX at 4.7, TYX is at 4.9, pushing to 5% right now. And again, if you look at the bond futures, we're seeing the sell-off here on the data. And so again, this is typically reflective of inflation expectations. And this is something that's really ticked up this week, and the jobs numbers only help support that inflationary kind of outlook.
But then the question is it inflationary or is it stagflationary?
Well, right. So again, this says what? So we go back to the ES. It says stagflationary, right? Now, what did gold do? So stagflationary gold typically does better, and we saw the kind of reversal down here. We've kind of reversed and gone back higher on GC, and this is where again, does the dollar weaken in this regard? And so we're seeing that maybe so, right? We're seeing kind of a breakout here in gold intraday. Back this out again. We're kind of breaking out to the upside here versus yesterday, or sorry, the other day. Markets closed yesterday. So we're breaking out in gold. Seasonally, gold's very strong in January into early
Mhm.
November, or sorry, early in February. And it looks like we're getting that trend right now.
Will you throw copper in there really quick? I didn't ask you to have that ready, but I'm gonna have you throw that in there because I talked about this on Thursday. This is what we're seeing, not Thursday, I guess Wednesday, Worldwide Wednesday. We talked about
Mhm.
this, the fact that copper and gold going up is a sign of return to demand. And so we have inflation, but we also have increasing demand, at least in the manufacturing and global stage, because copper prices are rising
Yeah.
quite quickly, and we just cleared that high. So I would have normally expected to see this going down, and and tragedy that has hit and struck California. I do think that you're going to see a continued indication or rise in the demand of copper because copper's number one use, according to the U.S. Geological Survey, is still housing.
Yeah. Well, it depends when you get permits, right? So,
Yeah,
so the
yeah.
delay might be there, but yeah, I mean, FCX obviously is a player in copper and gold. Again, we're kind of took out the prior high here on the 8th. We got earnings coming up, but it's edging higher in the after hours as well, pre-market. So we'll see what happens, but so we're not really gonna go 5 day, 5 minute, I guess. Seeing kind of edging higher, over the last couple of days. So maybe we see some strength there. I'm going to talk about a miner and BHP here, but FCX is also another miner, reasonably valued down here at down around the 38 to 40 area. So we see strength in gold, we see strength in copper, should help FCX. But we start to talk about inflation. PMI came out earlier this week, and when we look at PMI, again, we're just looking at the number. So let me just scroll up here. So we look at ISM Services PMI. Greater than 50 is expansion. Okay, less than 50 is contraction. So we say we came out better than expected, higher than last month. But the kind of an internal here of the services PMI is an aspect of rising inflation. So we look at composite PMI output. We're looking at increased inflation expectations, and that's a problem. We look at the betting markets on inflation. 4.1% is the forecast for 2025. So now all of a sudden we're seeing inflation rear its ugly head right now. And you said, is this going to be um, stagflationary rather than just purely inflationary? Meaning that is this due to growth or is it due to other factors?
Right. Well, and when they announced immediately that FEMA is going to cover all the firefighting expenses, that's $2 to $4 billion already.
Yeah,
And they're just talking about the firefighting and the response stuff, but whether there's going to be additional spent expense to help rebuild, that's another story. But
yeah.
we're talking about billions of dollars of extra expenditures on top of everything else. That seems to me that inflation is being driven off of spending, not off of growth.
And you're probably going to get some economists out there that are going to get really giddy, saying, "Oh, look at all the growth opportunity. We get to rebuild Hollywood, right? And we're going to rebuild LA. What a great story for creating economic growth." But they don't. The thing that they don't think about, it's not about productivity. It's about activity. And so, yeah, you might get a boost from GDP, but what's really happening in terms of the economy is a net negative, right? We're
Mm.
rebuilding productive assets that just got destroyed. And so there's no real gain economically. You might have a flurry of activity in the local construction market in California, assuming they'll let them rebuild the homes soon, not wait years. But the net effect economically is a drag. And so it creates stagflationary pressures because prices of stuff goes up, demand goes up, but we just destroyed, we're just remanufacturing productive property, productive assets that are just got destroyed in a fire.
Yep.
So
It reminds me
insurance
a lot of
company stocks,
1984.
I'm like, what's the effect on a company like, like Allstate here, for example. I mean, Allstate, we're not seeing any. We're seeing what's looking after ours here. We're getting about a $10 decline. So you might expect stuff like, Allstate could see some pressure. Um, oh shoot, forgetting Aflac, AFL. Will they experience it? Renters insurance. I don't know.
Yeah, what
Um,
about Prudential still quoted? PRU.
I know. See, yeah,
Yeah, there you go.
Prudential smaller down. Yeah, Allstate's seen the most effect, but 10 points. That's a decent decline here
Yeah,
on
there's
insurance.
definitely going to be some pressure in that area. A couple of things to remember as well. They also do reinsurance, so
Yeah.
they will hit their maximum, and then they offload a lot of their risk over to the reinsurance companies, the ones that back them up, which are usually Cayman Islands type of
Yeah.
companies. So
Like,
they will get hit, but not big
it's,
losses, or don't destroy insurance companies.
makes you wonder about mortgages too. I mean, people are like, because they still have to pay their mortgage.
Yep.
No home, it's going to take me a long time to rebuild. And again, I don't know how many of these homes are, very wealthy homes too, but as it expands, I mean, you start to have people that can't afford their mortgage because they don't have a home, they're living somewhere else. Um, so yeah, this is a real catastrophe. It's going to have an effect on the broader market. We did a bearish playback here on AFL. Initially, it was right here, and it kind of popped, then dropped, just based on the hurricane stuff. But yeah, this might be a play. Might be a play or just consolidate AFL or Allstate, just on the breakout.
Oh, looks good. I think there's plenty of opportunities. The question that we've got here in the next 15 minutes, with everything that's going on, with the idea that there's inflation, with the take California and set it aside for just a minute because that's going to have some impact. But the big picture, we're talking about something that's been building for years and decades. So as we're facing this inflationary standpoint of it's going back up, we know that we're probably not cutting rates. What are your picks for the year, Brandon? We've got
I was
a
going to
few
show this
minutes.
one slide really
Okay, sorry.
fast. No, it's okay. This is S&P forward earnings yield against the 10-year. So we're seeing as a negative number. What does that mean? The forward earnings yield of the S&P 500 is now a 0.5% less than the 10-year. We're seeing inflationary pressures drive up bond yields, which is raising the bar in terms of what the market needs to achieve in terms of return to outpace bonds. And right now, it's not expected to. So the point being is that there's going to be additional pressures on the broader market to perform, to produce. Again, I've been kind of hitting on RGTI the last couple weeks, but talking about, hey, you're going to wake up a 50% decline. We almost got that here, and this kind of just this excess is GameStop, short covering, gamma squeeze that happened here. You got to be careful with these kinds of names that don't really have a business, right, or a real sound business. We talked about MSTR. So as we think about our three, and we kind of hit this back here, right? The
Yep.
risks in these types of companies. So we have to be really careful with these kind of names where the business is in deterioration. The only reason it's going up is because of these kind of short squeezes, high short interest type phenomena that's precipitated by option trades, creating that gamma to short squeeze. And then you get the big turnover and it's done, right? So we got to kind of reshape our thinking in terms of, are the same stocks going to perform well in 2025 that did in 2024? This is a who moved my cheese moment. And we're going to talk about where the cheese has moved to potentially,
Right.
our top three.
Well, and I think that back to MSTR and all these, remember that not only are they high flying, even the Bitcoin, we keep saying, do not bet that the market can go down and Bitcoin will go up.
So we just
Statistically
saw,
speaking,
gold's going higher. What about
yeah,
Bitcoin? Is it responding the same way? Not really.
yeah.
It's just showing
No,
some weakness. We look at a 1 day, 1 minute chart. We saw selling on the news, which again shows that part of this. It's the money supply. People are speculating. This is a paper market. This is not Bitcoin. This is a paper market for Bitcoin. As those paper profits evaporate, as those paper gets reduced, as people pull their money, um, yeah, it starts to go down. One of the areas that's been pulling money is look at TLT. So the shows Sarah's outstanding. Um, eh, so it's not really giving us a lot of data. Anyway, whatever. All right.
All right.
So July they stopped doing last year. So look at shares outstanding reflect the money's being pulled out of the bond market, but oh, it's not there. All right, so dun dun dun. We got our top three. Blake, kick this off.
Yeah,
Let's
mine is
crack
real
open a
simple.
Coke here.
Mine is simple.
What?
I think we be safe. Be safe, my friends. With
Yeah,
everything that's going on, with all the chaos, with everything that we should be being wary of, I'm going back to the strongest stocks with the best dividends, with the ones that are underpriced. And that brings us to Coca-Cola, well, really consumer staples, Coca-Cola,
yeah,
PG, and Mondelez. And so we can see these bounces, a fantastic bounce yesterday. I don't know if it's going to sustain it, but to me, this is a defensive area. It's pulled
mhm,
back, it's defended the lows. And even if it doesn't move, they pay a high dividend. They pay a good short put
yeah,
on this level. And you can make 3% for the month, get assigned, and then be paid a very good dividend, even if it doesn't go up. If this is going to go up, we have a lot of upside potential too. And I love the fact that, you're getting up close to that Fibonacci, but you're at 50%, and the 50% pullback is going to be key there too. And some would say, oh, it's a head and shoulders. Nah,
yeah. Well,
that's just my
look, I
answer.
mean,
Nah.
we did some analysis. I did some analysis back here at the high because we're looking at some dividend aristocrat type companies, and the idea is really we're looking at $60, off the break here. So again, I've been bullish on Coke. I didn't put in my top three, but I like the defensive opportunities. I like the idea of dividends. We've been trying to beating that drum now for about a month or close to 2 months now. Is the idea, hey, look for some of these opportunities and the $60 threshold with the yield. It's a pretty decent range to look at this stock. Now Procter and Gamble is a little higher in its relative range,
Mhm.
but so what do you think here, Blake?
I just think it's similar. We're deeply discounted for the year. And so coming off the top down 160, we're talking about a $20 move just to retest the highs, and it's being defensive. I think they're going to have a surprisingly good earnings, but uh, because I know that there's been some good runs, the panic buying that's already kicked in randomly across the country again. And so, or less than random. And so I do think PG is going to have a better than expected earnings. I do think that they are stable at a very discounted price from November, but that also was August. That was also May and June. And so there's a lot of opportunity there. They pay a good dividend. And again, the options are allowing us to short put play into this one. And go ahead and give me go ahead and give me February. You can see that at the money right now, we're somewhere in between, but we're getting 2%, 2.5%.
So
So
you get 320. That's your break even is 160 minus 320. So that's let's round to 157, but that's down here.
yeah,
So you got a little bit
yep,
of downside protection when yours come well. You pop up here. So Procter & Gamble. Let's look at Mondelez. So all these are consumer
consumer staples.
staples, which again, if we think about the dogs of the Dow, right? What performed poorly last year? Consumer staples didn't do so hot, right? So again, we might see the rotation back to this area.
This is my most aggressive defensive move because we've gone all the way down from 78 down to 58. And so massive decline here. And I don't see the bounce yet, but this is one I do think you have just huge potential, even just go back to the previous lows. So to get
Yeah,
back to the previous lows, that's a big gain. We're talking about a 10 to 15% gain to retest the lows.
yeah.
I'm not even talking about going up to the highs. And so I'm waiting for this one to give me a better bounce. Yesterday was looking like it was trying to, but it kind of fizzled out. So, but it still looked like it defended the same low. So I'm not buying into MDLZ yet, but I do like this one as a setup.
This one, I mean, you could actually wait for the earnings to happen at the end of the
Yeah.
month that we break out. There's enough upside here potential, right? So if we beat the earnings, the revenues, raise the outlook, the stock price goes up, you might have maybe not 64, maybe 69 as retracement levels or multi-year lows here, and you've got a dividend that's 3.25%. So like it. If you want, you can also
Let's take a
consider if
look.
you want to buy the stock, just take the 47-cent dividend, and you got a 24 January 31. What's the date? It's the 27th, I think, right? So you can come here to 31 Jan. You can even take 50 cents. Maybe you can buy 57. These are kind of off in here a little bit, but maybe you buy
Yeah,
57, maybe 56. $56 is right here, right? You have
yeah,
upside to 64. It raises your again, you can take that dividend and be able to pay for that.
yeah.
So
I always like that strategy as well.
yeah.
Uh, use an upcoming dividend to pay for a put, so you have a guaranteed no risk. Now you've kind of went a different direction than I did.
Yeah, so like we've been hitting the consumer staples. I did a session yesterday on value oriented plays, and so I've got a more growth oriented play. I've got a potential play if commodity prices go up, but it pays a good dividend, and then I've got a play here that is a consumer staple but has massive short interest and short ratio, has potential for a big squeeze. Maybe not quite like an RGTI or those kind of companies, but could be close. So on PayPal, this is what I've been really bullish on here for a number of months. We had it back here. Most all of this last past year has been on my list. We've had a pretty big retracement from the prior trend, but when we start to back this out 10-year weekly, you see how down we are. So again, we got bullish back here in July. It's had a phenomenal trend, but this is one that if the earnings come out well, we could see another breakout here in PayPal and reaching additional levels, 100, 110. We can start to retrace big time. So for PayPal, with the earnings coming up on February 4th, you can wait for the earnings to happen. Again, if the company beats revenues and earnings, we raise guidance and the price breaks out, it's a buying opportunity. And you back this out to 10 years and you think, okay, a 38% retracement of the downtrend gets you back to 150. This is a company that's still seeing revenues go up. Revenues are higher today than they were in 2021. That's just how overvalued it is. Not expecting to get back to 300. Could we get to 150? Could we get to 127? Those are reasonable potential opportunities for PayPal in the next year if we see a continued trend in earnings. Now, again, if we own recession, that's a problem. Okay, but right now, again, we're doing well. Wait for things to happen. Look for the breakout, or you can buy a protected put. That just means with the earnings coming up in early February, just buy like a 7 Feb here. It's going to cost you a little bit, but 30 delta 83. It's going to cost you about let's say 220, 230. You're adding a couple bucks. It's like you bought it at 90-ish, right? So you can protect yourself with not a lot of cost. And again, if it comes out well, you got the upside. You're alleviating the downside around 85. BHP. So this is a miner. They're in the iron ore space, but they produce a lot of other stuff, coal as well, because anything you pull out of the ground, you're going to strip it. It's down a lot. The company pays a 6% yield right now. Again, the dividend's not every quarter. So again, that may or may not be there, but again, stock is down significantly. The valuations there we're at the 2022 lows.
Wow.
Again, earnings coming up. So again, you could wait for the earnings, see if the earnings come out positive, beat, raise, go up. Could create an opportunity here to break out in BHP. We could see it run back to 62. So I think it's a good opportunity. And again, chances are they'll pay a dividend. Again, particularly if they're more profitable, they could create an opportunity there. And finally, we got Fizz. Now, Fizz, back this sucker out 10-year weekly. We've just been consolidating here for several years. But man, if you look at the short interest on this stock, again, we need a catalyst here, right? Positive news. I actually got Fizz up right now, I think. Um, yeah, National Beverage statistics, 11% short interest. This is a very low float stock. So 11% isn't extraordinary, but what is extraordinary is that this 2.68 million shares that are short are 21 times the average volume right now. So all this thing takes is just a breakout, and this could make a big move, a la what we saw back here in 2021, right? So again, this was on my high short interest watch list in 2020. Again, it's still there. and we need a catalyst, but this could see a big move. But again, it's a value stock, it's a consumer defensive company. And again, just get a little bit of movement. You can get some big moves quickly. Even a move to 52 gets you almost $10.
I like that one. It's really interesting one I never look at. So it's always fascinating when I
Yeah.
see
It's
something
always like
I never look at.
the short, so it's a high short interest stock. So it's always kind of in the background, but yeah, but I think we're back to an area where we might see some just accumulation of 50, which is 6.5 points. Still a good percentage off of 43, with the potential for bigger breakouts there.
Yeah, no, that looks really good. Um, it's and I liked your BHP as well. It's kind of like the Mondelez. It's maybe still in a little bit of a free fall,
Yeah.
but do you think they'll get a lift from utilities?
Maybe, right? I'm like, there's pretty strong demand for coal in China, for example.
Hmm.
Yeah, maybe
Yeah,
metals perk
they
up.
still use tons of coal for
Yeah.
their power plants. So
And we've
no
seen
pun intended.
the last week there's been some pretty significant call activity in stocks like CLF, um, in aluminum like CENX, for example, Alcoa, US Steel. They haven't all played out positively, but there's been activity, call option activity. I call them like a pre-move option pulls, but in the space, and again, BHP is right in the mix with those companies too. So
Yeah.
see what happens.
So we've got a lot of interesting stuff coming up today. Don is going to open up the main room session here talking about the bond resist renaissance. I was going to say the resistance, but that's another thing. Renaissance, resistance, it's all the same. They do have the $1 million challenge introduction if you want to catch that a little bit throughout the afternoon. That's going to be there as part of that free area to take a look at it. And that $1 million challenge is coming up and launching here as well.
Yeah.
But there's
Today's the day, so you got to hop on it.
yeah, there's some really kind of exciting things going on in the market. There are going to be real opportunities, but there are also areas that when you see real opportunities, it's kind of like the reverse Spider-Man, where there's great power, there comes a great responsibility. This is when there's great opportunity, there's also downside risk. So just be really careful here as you're setting up and lining up these trades. There's a lot going on in the markets, things that we haven't seen. I mean, the bond sell-off is huge,
Yeah.
and whether we can stabilize here or not is going to determine whether we're going to see double-digit interest rates possibly in the next decade. So we'll see. It's wild movements, wild swings with inflation on the rise, still could be there. Brandon, any parting shots?
It's just right now, again, we're still in that climate. A lot of stocks are below the 50-day moving average, which short term can be bullish. But again, this might be a scenario where we're going to see a lot more downside drag below the 200-day moving average. So that's really what you got to be prepared for. So keep some powder dry, look for some opportunities, but the risk is still in the market right now.
All right. Well, thank you, Brandon. Thank you, everybody. Have a fantastic day. And if we don't see you today, have a fantastic weekend. Thanks,
All right.
Brandon.
We'll see you.